Welcome to the part 6 of option trading video series. Trading options for beginners remains my focus, and today's option trading video is about vertical spread, and the strategy we are going to discuss in detail is bull call spread. Over the last 5 parts I have discussed option trading basics in detail. From part 1 to part 5 I have discussed various topics about option trading, option selling, long call option trading strategy, and covered call option trading strategy. In case you have landed on this video directly, I would strongly recommend to start with part 1 of option trading series. Link to the videos is in the description box below. So today we are going to discuss about bull call spread, which is a type of vertical spread option trading strategy. I'll take you through brief overview of bull call spread along with the basics. Then I will explain the difference between debit spread and credit spread strategy. Once we are finished with this, I will then explain bull call spread with help of an example, followed by a risk profile of bull call spread strategy. I will then touch upon conditions when one should think about applying this strategy and how this strategy differs from long call option trading strategy that we saw in part 2. In the end, I will also explain one variant of this strategy, that is aggressive bull call vertical spread. So first, let me begin with basics of bull call spread. Now, bull call spread is a type of vertical spread strategy. It is created by buying at the money call options and then simultaneously selling, that is writing out of the money call option. It's important to note that underlying instrument or stock or index remains the same, and the expiry date for both options should be same, along with the number of lots that are bought and written. So for example, if Nifty is at 10,000 spot level and you buy one lot of at the money call option with strike price of 10,000 December series, then you have to sell one lot of out of the money call option with strike price of 10,100, 200 or 300 for Nifty instrument for same December series only. So I hope this part is clear. So bull call spread is a strategy which is implemented when outlook for a stock or index is moderately bullish. This is not a strategy that you should apply when you are extremely bullish on the underlying instrument. This is when trader actually expects some mild bullish bias to continue but does not expect any massive movement in the underlying asset. In other words, trader is not expecting any significant momentum in the underlying stock or index. So bull call spread is a two-leg strategy which traditionally involves buying at the money call option and writing out of the money call option. You can experiment with different strike prices to make this strategy more or less aggressive or conservative, and I will be covering about this in later slides. So this is what you basically do in a bull call spread strategy. You buy at the money call option, you sell out of the money call option. This is to be done when the outlook of a particular asset or a stock is moderately bullish. There are a few key things to note. Number one, the underlying stock or the index remains the same, expiry series remains the same, and the number of lots that you buy or the number of lots that you write remain the same. So bull call spread is a type of debit strategy. When you look at various vertical spread option trading strategy, you'd come across credit vertical spread and debit vertical spread. Now bull call spread is a debit spread strategy as there is a net debit to your account when you initiate this particular strategy. I will cover more of this when we come to specific examples. In this particular strategy, you are buying at the money call options and writing out of the money call option. When you buy at the money call option, you will be paying the premium, whereas when you write out of the money call option, you will be receiving the premium. Difference between this premium paid and premium received will cause a net debit to your account. It's important to note that both profit and loss will be capped in this strategy. I will explain this part about the profit and loss segment and the part about net debit in the next particular section. So let us now begin with example and risk profile chart for bull call spread strategy. In this section, we will cover an example in detail. I will be showing how to calculate maximum profit, maximum loss, break-even point, and how to plot the risk profile chart for this particular strategy. I have selected Reliance stock as an example, and I've taken up a real option trading chain for Reliance to help you understand this concept better. Reliance is a fairly liquid stock, both in the cash and derivative segment. At the time of selecting Reliance for this particular example, it was trading at spot price of 1160 and 20 days were left for expiry. I assume that mild bullish bias continues in this stock for the next 20 days, and that is how I want to put forward this particular strategy. Let's recollect that we will create bull call spread strategy in Reliance by buying at the money call option and by writing out of the money call option. For the sake of understanding, I will begin with buying and writing just one lot of at the money call option and out of the money call option. So this is the option trading chain of Reliance. Remember, spot is at 1160, that is 1160. To create a bull call spread strategy, we select the at the money strike price of 1160 and out of the money strike price of 1200. That is both call options. Now we buy one lot of 1160 call at the rate 41. That is, we pay a premium of rupees 41. We also write one lot of 1200 call, that is out of the money call, at the rate 23. That is, we receive a premium of rupees 23. Therefore, the net debit, that is 41 rupees paid for the 1160 call and 23 rupees received for the 1200 call, would be rupees 18. That is 41 rupees minus 23 rupees. So this is why bull call spread is a debit vertical spread strategy. There's a net debit when we create this particular strategy. I hope the debit part is absolutely clear. So this is the risk profile graph for bull call spread strategy. I had mentioned earlier that both profit and loss is capped in this strategy, and in the next few slides you will understand why. So let us recollect that we have bought one at the money call of strike price 1160 at the rate 41 rupees, and we have written one out of the money call of strike price 1200 at the rate 23 rupees, and we have had net debit of rupees 18. So break-even point for bull call spread is calculated as the sum of long call strike price, that is the strike price of call that you have bought, plus the net premium paid for creating this strategy, which is strike price of the call that we have bought is 1160 plus rupees 18. This is the net premium we have paid for this particular strategy. So you will make money in this strategy as far as price moves above rupees 1178. Hope this particular point is clear as well. I'll repeat once more. So break-even point of bull call spread strategy is long call strike price, that is the call option strike price where you bought the call, plus the net premium paid for creating this strategy. So in this particular example for Reliance, we went long at 1160, and the net premium that we paid to create this particular strategy is rupees 18. So break-even point would be 1160 plus 18, that is 1178. I hope this is clear. So the maximum profit in bull call spread is calculated as sum of strike price of written call minus strike price of long call minus net premium for this particular strategy. So in this particular case, for the Reliance example, the strike price of written call is 1200, strike price of long call is 1160, and the net premium for this particular strategy is rupees 18. So overall, the maximum profit that you can achieve in this particular strategy is rupees 22, which is marked here on the chart. So the next section that we move on to is estimating the maximum risk or maximum loss in this strategy. Calculating the maximum risk is pretty straightforward. Maximum risk is the net premium that you paid to create this particular strategy. So in this particular case of Reliance, we have paid rupees 18 per lot to create this strategy. Therefore, the maximum risk or the maximum money that you can lose in this particular case is rupees 18 per lot only. So what we have seen till now is that profit and loss for this strategy is capped. If you see, maximum risk and maximum profit that you can make is both capped. Now, at the money call which you bought gives you opportunity to profit immensely. However, the out of the money call option which you had written caps the overall profit. So therefore, by writing out of the money call option, you're limiting your overall profit potential. Now, this is a very common question that comes from trader, that through a bull call spread, you are essentially limiting your profit potential. I'll also tell you a flip side to this. By actually writing out of the money call option, you are also lowering your overall cost. Now let me explain this how. Now let's assume that you had initiated a long call strategy. Your cost for acquiring the 1160 at the money call option would have been rupees 41. Now had trade not worked out in your favor, you would have lost that rupees 41 entirely, right? Now, since you have written the out of the money call option with strike price of 1200, you have received a premium of rupees 23, which means if the strategy will not work in your favor, the maximum that you would lose is a premium of rupees 18. Therefore, you have reduced your cost while being bullish on the asset. One more important thing that I want to point out is that of commissions in this particular strategy. Now make sure you have a discount broker in place for this because commission does matter, but ensure brokers' systems are stable and they don't freeze on event heavy days. Now this is very common that whenever event heavy day comes around, a discount broker's system usually freeze. Now especially their support or helplines, you just cannot get through them, and this is a very common problem. So my advice here would be that don't go behind discount alone. Be wise to choose a combination of discount and system stability, and ask your broker for how their systems are efficient enough to handle such particular days. So now I'll come to various expiration scenarios and how you can do the calculation and understand on your own. So let us assume that in our particular example that we took, Reliance would now expire at 1150. Now do remember that we have actually bought one lot of Reliance at 1160 and we have written one lot of Reliance with strike price of 1200, right? So the first case that we would see is what happens if expiration happens at 1150. That is, the Reliance spot is at 1150 level on the day of expiry. Well, in this case, the 1200 call option which we had written will move to 0. Therefore, we get to keep rupees 23 as premium. The 1160 call option which we bought will also be 0, which means that we lose the rupees 41 we paid initially to acquire this 1160 call option. So therefore the net loss would be 41 rupees that we paid plus 23 rupees that we received, that is rupees 18. Now let us take the second case where we'll see what happens if expiration happens at 1160. Again, the 1200 call option which we had written will be 0 and we get to keep rupees 23 premium. The 1160 call option which we bought would also be 0 and we would lose the rupees 41 premium that we paid. So therefore the net loss again would be minus 41 plus 23, that is rupees 18. Third case that we would see is what happens if expiration happens at 1200 spot price. Well, the 1200 call option which we had written will be 0, therefore we get to keep 23 premium. The 1160 call option would have 40 rupees as intrinsic value and we bought it for rupees 41. Therefore the net value for this will be minus 1. Now at this particular case, some of you would be questioning how this calculation is done. Now let me explain this. So the 1160 call option which we bought has an intrinsic value of 40. Now how do we calculate intrinsic value? That is the spot price at which expiration is happening minus the strike price, which would be rupees 40. Now since we bought this option for rupees 41, our net gain in this would be intrinsic value minus what we paid, that is -1. I hope this point is clear. Now we have received rupees 23 as premium for the 1200 call option, which went to 0. So the net gain will be 23 received, that is the premium received, plus the gain that we have made in 1160 call option, that would be rupees 22. So the gain that we get out of this strategy when option expires at 1200, that is the Reliance expires at 1200, that would be rupees 22. So the last case that we would consider is if expiration would happen at 1220. Now the 1160C, that is call option which we bought, would have an intrinsic value of rupees 60. How rupees 60? The spot price at which Reliance is expiring minus the strike price where we went long, that is call option, that is rupees 60. And we bought this particular call option at 41. So the net gain that we get is rupees 19. How rupees 19? That is rupees 60 minus rupees 41. So we make rupees 19 on this particular call option. But do remember that the 1200 strike price call option that we sold at 23 will have an intrinsic value of rupees 20. Now how did I calculate this? Look at the price at which Reliance is expiring for that particular series minus the strike price, that is rupees 20. So the net gain in this particular call option leg which we have written is rupees 3. So the net gain for this particular strategy, in case it expires at 1220, it will be 19 plus 3, that is rupees 22. So I know this particular part about intrinsic value might be confusing, but don't give up here. In case you watched part 1, part 2, I have covered all this in great detail. If you have watched that part 1, part 2 and still you're a little bit confused, what you can do is just pause the video here, go back about 2-3 minutes and start again. So this particular calculation will be pretty clear. So I've put out a table here with various expiration scenarios. In case you have understood the previous 2 slides where I've shown you what happens if expiration happens at 1150 or 1200 or 1220, this table will be pretty clear. What you can do is, still for the sake of understanding, you can yourself take a case study of, let's say, a price expiring at 1190 and do this calculation and verify whether it matches or not. So for the sake of understanding, I'll just pick out one more example. Let's assume that expiry happens at 1190, how you will be calculating the profit or loss. So for the 1160 call option that we bought, intrinsic value at 1190 would be rupees 30. That is 1190 minus 1160, that is 30. Premium debit that happened when we bought 1160 call is minus 41. So the net gain that you made in this long call will be minus 11 if the price expires at 1190. Now the intrinsic value for 1200 out of the money call option that we had written, that will be 0. The net premium credit that we received was 23. So the net gain that we made in the short call, that is the call we had written, is 23. So the net profit and loss for this entire strategy would be 23 minus 11, that is rupees 12. So rupees 12 per lot you will be gaining in case price expires at 1190. So I hope this particular calculation is clear. Now I have put out in a table format because I had received an email from one of my members that it would be better if an entire table is put out so that they can do the calculation themselves and understand better. So which is why I have put it out. So one variant of bull call spread that I wanted to discuss was the aggressive bull call spread. Now bull call aggressive spread is similar to traditional bull call spread, except for the fact that in aggressive spread, trader expects far more upside till expiry. In aggressive spread, trader widens the spread between options bought and option written. So let us take the previous example to understand this. In the previous example, Reliance at the money call was bought at 1160, that is 1160 strike price at 41, and 1200 call was written for a premium of 23. So maximum profit was rupees 22 and maximum loss was rupees 18. So the risk reward for this trade was maximum profit divided by maximum loss, that was rupees 1.22. Now if a trader is really aggressive and he initiates an aggressive bull call spread, he would actually buy Reliance at the money call option 1160 at 41, and he will write Reliance out of the money call option with strike price of 1240 for a premium received of rupees 12. Now in this particular case, maximum loss would be rupees 29 per lot and maximum profit would be rupees 51. And the risk reward would be 1.75, which is better than the risk reward when he was conservatively executing this trade. Back then the risk reward was 1.22. As we can see here, risk and reward is now skewed towards the trader if trade were to work. Having said this, now I have a simple question for all of you. If someone is so aggressive and bullish, why not go for a simple long call strategy? Why prefer a bull call spread strategy? Well, the answer is very simple. Now long call option trading strategy has unlimited loss and unlimited reward potential. If a trader is aggressive and still wants to limit losses, he would actually prefer an aggressive bull call spread instead of a long call strategy, just because his overall risk is limited. The only thing that trader has to watch out for is to spot underlying momentum. If he can spot momentum beforehand, then it is advisable to initiate an aggressive bull call spread strategy. Else, it is always better to stick with the conservative version of bull call spread strategy. So I hope all these points are clear. Now at any given moment, if you have any doubt, just let me know in the comment section below and I will get back to you as soon as possible. So this was the theoretical part of bull call spread strategy. In next part, I'm going to take a Bank Nifty as an instrument and I'll show you how to execute this strategy in the direction of ongoing trend. I'll also be showing you what are the ideal conditions for the same and how you should manage risk. Once I'm finished with the next video, that is the practical application of bull call spread strategy, then the next option trading topic that I will be covering will be bull calendar spread. Remember, we are in the call option segment, and once I finish the call option segment, I will move to put options and then to open interest analysis and practical examples. So the release schedule will be notified next week. In case you have any doubt about what I've shown you, do leave a comment below and I'll get back to you as soon as possible. Kindly prefer leaving a comment below to ask your doubts. A lot of you are sending me emails. It takes a little time to reply to emails, whereas on YouTube, I'm pretty quick in answering all the queries. So thanks a lot for watching, guys. Be safe.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.